Wait, this doesn't make sense. Stocks are crashing, but gold is also falling? Isn't gold supposed to rise when markets fall? That's the rule most investors believe in. When equities decline, money usually flows into gold because it's seen as a safe haven, a store of value that holds up when confidence in the economy weakens. We saw this clearly during the 2008 financial crisis, when stock markets collapsed but gold prices surged as investors rushed towards safety. But in early 2026, something very unusual happened. Both stocks and gold started falling together, and that confused a lot of people. The reason lies in a rare, perfect storm where multiple global forces hit the financial system at the same time. First, rising geopolitical tensions, particularly between the United States and Iran, pushed crude oil prices above $117 per barrel. When oil prices rise sharply, it increases transportation and production costs across the economy, which then fuels inflation, meaning everything from food to fuel becomes more expensive. This created fear that inflation could spiral out of control. At the same time, global investors rushed toward the safety of the US dollar, which is considered the world's reserve currency. As demand for the dollar increased, its value strengthened significantly. Now, here's the important connection. Gold is priced in dollars globally, so when the dollar becomes stronger, gold becomes more expensive for buyers using other currencies, which reduces global demand and puts downward pressure on gold prices. Alongside this, central banks and markets started expecting higher interest rates to combat inflation. When interest rates rise, government bonds and other fixed income instruments start offering better returns. This creates an opportunity cost for holding gold because gold does not generate any interest or income. So naturally, some investors begin shifting their money from gold into interest-bearing assets. But the most critical factor, the one that really triggered both markets to fall together, was margin calls and forced selling. Large institutional investors like hedge funds often use borrowed money to amplify their investments. When markets begin to fall, the value of their holdings drops, and lenders demand additional collateral to secure those loans. This is called a margin call, and when investors can't immediately provide extra funds, they are forced to liquidate their positions quickly. The key point here is they don't selectively sell weak assets. They sell whatever is liquid and can be converted into cash fast. That includes stocks, gold, and even cryptocurrencies. This kind of selling is not based on long-term value. It's driven by urgency. As more investors face margin calls, this creates a cascading effect, where selling triggers more selling across all asset classes. This leads to what is known as a liquidity crunch. In such a situation, the priority shifts completely. Investors are no longer thinking about returns or safety. They just want cash. The only assets in demand become highly liquid and secure instruments, like short-term government securities, especially U.S. Treasuries. Everything else, including gold and equities, gets sold off. A simple way to understand this is through a real-life analogy. Imagine you own a car and gold jewelry. Under normal conditions, you would consider your gold jewelry valuable and hold on to it. But if you suddenly face a financial emergency and urgently need cash, you might sell both your car and your jewelry, not because they've lost value, but because liquidity becomes your top priority. That's exactly what happened in 2026. So, to summarize, stocks fell due to economic pressure, inflation concerns, and weakening growth expectations. Gold fell due to a stronger dollar, rising interest rates, and reduced global demand. But both fell together because of forced selling caused by margin calls and a system-wide liquidity crunch. In the short term, this kind of environment creates extreme volatility and uncertainty, where traditional relationships between assets can break down. However, over the medium to long term, gold still retains its role as a hedge against inflation, currency depreciation, and geopolitical risk. And the biggest lesson from this entire episode is simple but powerful. During periods of extreme financial stress, liquidity dominates everything. It doesn't matter how safe an asset is in theory. When investors need cash urgently, everything can fall, because in that moment, survival matters more than strategy, and liquidity becomes more important than logic.